This is Anne-Marie Cederholm, and today I will be reading Chapter 5, Operating and Financial Leverage, published by McGraw-Hill. Chapter 5 Outline. What is leverage? Break-even analysis, operating leverage, risk analysis of leverage, financial leverage, indifference point, combined or total leverage, summary and conclusions. Learning objectives, Part 2. Define. Define leverage as a method to magnify earnings available to the firm's common shareholders. Calculate. Calculate break-even in units and in dollars. Define. Define and calculate operating leverage and assess its opportunities and limitations. Learning objectives, Part 2. Define. Define and calculate financial leverage and assess its opportunities and limitations. Calculate. Calculate the indifference point between financing plans using earnings before interest and taxes and earnings per share analysis. Define. Define and calculate combined leverage. Leverage in a business. Leverage is using fixed costs to magnify the potential return to a firm. Two types of fixed costs. One, fixed operating costs, like rent and amortization. Two, fixed financial costs, like interest costs from debt. Leverage in a business. Two types of leverage. One, operating leverage equals the degree to which capital assets and associated fixed costs are utilized. Two, financial leverage equals the amount of debt used in the capital structure, the debt-to-equity mix. Table 5-1, Income Statement. The operating leverage covers the sales minus variable costs, which equals the gross margin, or the contribution margin, divided by fixed costs to equal operating income. And then the financial leverage is the earnings before interest and taxes minus interest, divided by earnings before tax, minus taxes, equals earnings after tax, your shares and your earnings per share. Break-even analysis. A firm's operational costs may be classified as fixed costs, those costs that remain the same in the short run, for example, rental, amortization, executive salaries, property taxes. Variable costs, those costs that change as production and sales change, for example, raw materials, factory labor, and sales commissions. Semi-variable costs, those costs that may change but not directly related to production or sales, for example, utilities, repairs, and maintenance. Break-even analysis. Break-even analysis is the technique used to study the effect of sales volume on costs and profit. The interesting sales volume is the break-even sales level at which a firm's total revenue equals total cost. That is, the firm does not make money nor lose money. They break even. So break-even equals fixed costs divided by contribution margin. Figure 5-1. Break-even chart in dollars and units of a leveraged firm. Table 5-3. Volume cost profit analysis of a leveraged firm. So you'll see at the 50,000 units sold is where we break even, where we make zero operating income. Figure 5-2, break-even chart, conservative firm with low risk. Table 5-4, volume cost profit analysis for a conservative firm. So they have to sell 30,000 units in order to break even, meaning have a profit of 0. Operating leverage measures the amount of fixed operating costs used by a firm. Degree of operating leverage equals the percent change in operating income divided by the percent change in unit volume. A change in sales brings a larger change in earnings before interest and taxes, or operating income, if degree of operating leverage is greater than 1. Degree of operating leverage measures the sensitivity of a firm's operating income to a change in sales. Risk analysis of leverage. A leveraged firm has high fixed costs, a high break-even point, and high degree of operating leverage. A non-leveraged firm has a low fixed cost, a low break-even point, and low degree of operating leverage. Leverage is a double-edged sword. It magnifies losses as well as profits. Table 5-5, operating income or loss and difference point. So at 60,000 units, both the leveraged firm and the conservative firm will have the same income. Figure 5-3, nonlinear break-even analysis. Financial leverage measures the amount of debt used by a firm. Degree of financial leverage equals the percent change in earnings per share divided by the percent change in earnings before interest and taxes. Financial leverage. A change in earnings before interest and taxes or operating income brings a larger change in earnings per share if the degree of financial leverage is greater than 1. Degree of financial leverage measures the sensitivity of a firm's earnings per share to a change in operating income. Financial leverage. The formula for degree of financial leverage related to the income statement is called the degree of financial leverage. The degree of financial leverage equals operating profits divided by earnings before taxes, or EBIT divided by EBT. Table 5-6, impact of financing plan on earnings per share. The first is a leveraged plan and a conservative plan, with both earnings before interest and taxes being 0. The second is the earnings before interest and taxes for both the leveraged and the conservative plan, with their income being 12,000. And the third is the earnings before interest and taxes at 16,000 for both a leveraged and conservative plan. The indifference point on the earnings per share is at this level because the earnings per share is the same under both plans. Table 5-6, Part 2, impact of financing plan on earnings per share, with an earnings before interest and taxes at 36,000 and also 60,000 for a leveraged and a conservative plan. Indifference point. The level of earnings before interest and taxes at which alternative financing plans yield the same earnings per share. Mathematically, it's 24,000 shares times 12,000 minus 8,000 shares times 4,000 divided by 24,000 shares minus 8,000 shares. So in the question that we just looked at, the indifference point is 16,000. Figure 5-4, financing plans and earnings per share, indifference point. Figure 5-5, financial leverage in selected industries. And the source is from Statistics Canada, Quarterly Financial Statistics for Enterprises. Table 5-7, operating and financial leverage at 80,000 units and at 100,000 units. So move through the cost volume profit statement. Sales minus variable costs equals contribution margin, minus fixed costs equals the earnings before interest and taxes, minus the interest expense to get earnings before tax, minus your income taxes to get earnings after tax, and then take your earnings available to the common shareholders, divide that by the number of shares outstanding to get earnings per share. Figure 5-6, combining operating and financial leverage. Combined or total leverage. Combined or total leverage represents maximum use of leverage. So the degree of combined leverage is the percent change in earnings per share divided by the percent change in sales or volume. A change in sales will bring a larger change in earnings per share if the degree of combined leverage is greater than 1. Combining both leverage formulas, the degree of operating leverage times the degree of financial leverage, will equal your degree of combined leverage. Formula review. Break even is your fixed costs divided by your contribution margin per unit. Degree of operating leverage is your contribution margin divided by your earnings before interest and taxes. Your degree of financial leverage is your earnings before interest and taxes divided by your earnings before tax. And your degree of combined leverage equals your degree of operating leverage multiplied by the degree of financial leverage. Summary and conclusions. Leverage refers to the use of fixed costs to magnify the profits or losses of a firm. It is a double-edged sword. Management must be sure of the level of risk assumed. Operating leverage refers to using fixed operating costs, such as lease or amortization expense. Summary and conclusions part 2. The degree of operating leverage, DOL, measures the percentage change in operating income as a result of a percentage change in sales. Financial leverage refers to the fixed financing charge, such as interest cost on debt. Summary and conclusions part 3. The degree of financial leverage, DFL, measures the percentage change in earnings per share, EPS, as a result of a percentage change in operating income. The higher the level of fixed costs, both operating and financing costs, the greater the effect on net income of an increase in sales revenue. This is the degree of combined leverage, DCL.